Moody's cut Spain's credit rating one notch, citing the weak economic outlook. It follows S&P's cut last year. Ireland's state-owned Anglo-Irish bank needs more money. Our next guest says that these two facts show that a Eurozone crisis is building. George Magnus is Senior Economic Advisor at UBS in London. George, it's so good to have you with us this morning. So do these two news items really change your view about Europe? I mean, the Moody's cut of Spain, that follows S&P's last year, so arguably it's not really a new call. I guess we can hit Anglo-Irish in a minute. But, I mean, ratings agencies are often behind the curve anyway, right?
Yeah, I think we are probably lulled into a little bit of a false sense of security over the summer because even though things have been quite quiet in the Eurozone, as you've reported, for many weeks, the spreads on Portuguese and Irish and Spanish debt have been climbing back to the levels that we saw at the time of the crisis in the spring. Without much fanfare, but it clearly indicates that something's not right. And I do think that this is kind of gradually accumulating and building up to a new kind of investor problem sometime in the next several months, I think.
I know you said that the gloom is justified as we deleverage, but exactly how gloomy could it get? I mean, what is the worst case scenario that you see, George?
Well, as far as the Eurozone is concerned, I mean, there are really only three ways in which the crisis of sovereign debt and deleveraging can be resolved. One is the least likely is a spontaneous return of investor confidence, which we can basically push to one side, because that's not going to happen. So basically, you're only talking about two options, which is the next stage of the crisis, at which point European governments will have to agree either to have a kind of a fiscal transfer system, which kind of exists in the United States and the United Kingdom, but not in the Eurozone, or they won't, in which case there'll be a kind of a suboptimal solution, and then we're going to have to basically seriously start thinking about restructuring mechanisms for some of the poorer, sovereign invalids.
George, I want you to get to your third point, but I mean, do you mean just by inference that Ireland or Portugal or Spain is going to have to go to the EU then, as they have the right to do in the next 3 years?
Yeah, I mean, part of the, if you just take, for example, the Moody's downgrade of Spain today, okay, it's still, I think, AA1, so it's hardly, junk or anything like that. But the investor base for sovereign debt in Europe actually is shrinking because the pricing models have blown up. People owned Spain and Portugal and Ireland not because they were great credits, but because of the spread and because it was stable. Now, of course, that's all been shot to pieces. So the investor base is shrinking, and the supply of issuance from these governments obviously is continuing to rise. So there's a supply and demand problem, and there's a solvency problem. And I think that the idea that you've got countries with huge debt burdens but no growth, which is what Moody's were particularly concerned about, I think is a kind of a lethal cocktail.
All right, well, I'm looking at the market reaction, and it is somewhat muted. I mean, credit default swaps for Irish debt are dropping, so it does seem like fear is easing. The euro is still at 136. What is the third scenario, I have to ask you?
Well, the third scenario is the kind of is the part B of if you don't go to fiscal transfer system, and essentially that means that Germany and a few other European creditor countries would effectively, write checks to the debtor countries in southern Europe. If you don't have that, then you have a suboptimal scenario in which you have a kind of a patchwork monetary union, but it's one in which the restructuring of sovereign debt actually becomes much more likely. There has to be some sort of Brady bond type of mechanism to basically restructure and extend the maturities of the debt. And I think that is probably the more likely of those two outcomes. But I don't think that's going to happen in the next 3 months,
It's a bit longer term. Okay, George, thank you very much. George Magnus joining us there from UBS, actually our studios in London, but he is Senior Economic Advisor at UBS.